Welcome to another FAR walkthrough video from Superfast CPA. I'm Logan, and in today's video, we're going to be going over FAR Area 1, B3, and this is an application topic, adjust the statement of cash flows for a non-governmental not-for-profit entity to correct identified errors. And we're going to be doing that the Superfast CPA way, which is diving straight into questions. If you don't know much about our strategies, the main idea behind Superfast CPA is focusing on the things that you're going to be doing on test day, which is questions. So you dive straight into the questions to learn the material. Instead of watching lectures or reading through big textbooks, you cut straight to what you're going to be doing on test day. And if you want to learn more about our strategies, make sure you go to superfastcpa.com and check out our free 1-hour webinar training. We teach the key ingredients to passing the CPA exam, and we will teach you how to study effectively and efficiently so you can pass your exams without having to study 4 or 5 hours after work every day. The link will be in the description, so make sure you go check that out. Also, just letting you know, we will only be going over 5 questions today, whereas Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this and you want more of it, you can get more of it by becoming a Superfast CPA member. With all that said, let's dive straight into the questions. Alright, here we are at question 1, and as we're diving into these questions, I do want to say one thing. A lot of the stuff in this video is assuming or based off of the fact that you probably watched the previous video where we talked about preparing the statement of cash flows for a non-profit entity. If you haven't seen that, a lot of this is going to be difficult because how would you know how to correct it if you don't know how to prepare it in the first place? So if this is the first video you're seeing from us, that's great, but I would recommend going and watching the video I just posted before this one, which is about preparing the statement of cash flows for a not-for-profit entity, because that will give you a lot more context for this video, and then you can come back to this video. With that said, let's talk about this question. Now, one thing that we typically recommend for the Superfast CPA strategy is because you're doing the questions and using the questions first, you want to go straight to the bottom of the question so you know what you're looking for as you read through the rest of the question. So let's read this part. Which of the donations was classified incorrectly? So now we know, as we're reading through the rest of this, to be looking for donations that were incorrectly classified. A non-governmental not-for-profit entity recorded the following cash donations during the fiscal year and classified them accordingly in the statement of cash flows. Donation 1 was a $250,000 donation restricted for the purchase of a new community center, classified as an investing activity. Donation 2, $80,000 restricted for the purchase of new technology equipment, classified as a financing activity. Donation 3, $120,000 restricted for a specific educational program over the next 5 years, classified as an operating activity. And last, Donation 4, $50,000 unrestricted and used at the organization's discretion, classified as an operating activity. So as we read through those, again, you probably watched the previous video if you're watching this one, so you might already know kind of how this goes. If this is the first video and you want to continue watching though, let's go ahead and dive into the answer so that we can learn how this works. Alright, here we are at the answer, and the answer is A, donation 1 only is the incorrect one. So let's walk through this. Again, this is probably a refresher from the previous video, or if not, you're going to learn something new right now. Donation 1 is incorrectly classified because it should have been classified as a financing activity, not an investing activity. Contributions restricted for the purchase of long-term assets are classified as financing activities because they impact the entity's net assets. Again, we've talked about this in the previous videos, but the idea with nonprofit organizations is that net assets is basically the same as equity, and when you talk about the statement of cash flows, you're talking about investing, financing, and operating. Financing is usually about long-term liabilities and equity, or in this case, long-term liabilities and net assets. Now, when you get money that is set aside or restricted specifically for the purchase of something that is long-term, like it's going to affect your long-term assets, your net assets, you consider it a financing activity, even though the money might be restricted for the purpose of purchasing something like a new building, which when you purchase that, it would be an investing activity. But when you receive the money and it's restricted for that purpose and it's long-term and it affects net assets, it's a financing activity. So this should have been classified as a financing activity. And this donation 2 was actually classified correctly. So this was kind of a hint if you knew what to look for. This $80,000, since it's restricted for purchasing a long-term asset like new equipment, that should be classified as a financing activity, and it was done correctly. Same thing with donation 3, it was done correctly. This was restricted money, but because it was restricted for something that wasn't long-term, it's not necessarily going to affect net assets. It was just restricted for a specific program, but it's still something that has to do with operating activities. It can still be part of operating activities, even though it was restricted. So I'm just going to jump down here to this little explanation really quick. Remember that contributions with donor restrictions are considered financing activities only when they are restricted for long-term assets. If it is restricted for normal operations of the company, it is an operating activity. So don't get confused. Don't be thinking that every time there's a contribution with donor restrictions, it has to be a financing activity. It's only going to be a financing activity with donor restriction if it's specifically for the purchase or use to get a long-term asset, like a long-term investment for an endowment fund or a new building or something like that. If it's with restriction for something specific in operating activities, even though it has a restriction, it's still going to be used in operating activities. It's for operating activities, so that would be counted as operating activities. And then the easiest one right here, donation for $50,000 unrestricted. Clearly, it's for general operations. It's going to be used for operating activities. So they did it incorrectly. They should have classified this one as a financing activity, not as a investing activity. Donation 1 should have been that. Let's go to the next question. All right, here we are at question 2, and again, just before we dive in, let's read the last part of the question. Based on this information, determine which of the following statements is correct regarding the classification and total for investing activities reported by the museum in its statement of cash flows. Okay, so we know that we want to be focusing on investing activities for this question. So let's read through the rest of this. They had the following transactions, for its collection of artworks. They purchased a painting for $700K to add to the permanent collection, classified as an operating outflow. Sold a sculpture for $250,000 that had originally been acquired for $180,000, classified as an investing inflow. Purchased a rare artifact for $500,000 using a donor-restricted contribution received in a prior year, classified as an investing outflow. Receiving $200,000 in insurance proceeds after a painting valued at $300,000 was broken, classified as an operating inflow. Sold a portion of the museum's investment portfolio for $400K, classified as an investing inflow. Paid $60,000 for restoration work on another artwork in the collection, classified as an operating outflow. And finally, received a $100,000 cash donation restriction for the future purchase of additional artworks, classified as an financing inflow. So there is a lot of information there, and it is, again, we're trying to look at this from the investing activities. So again, if you've seen the previous video, you might have a good idea for what this should include. If you don't really understand what would go into financing, investing, and things like that, especially with works of art, that's okay. Let's go ahead and go to the answer. If you haven't already paused the video, go ahead and pause the video if you want to do the calculation. But if not, again, let's look at the answer together. All right, the answer is A. The total reported for investing activities is overstated by $560,000. So let's walk through this. There's a lot to it. There was a lot of transactions, so we're going to read through each one. So pay attention. The $700,000 purchase of the painting should be classified as an investing outflow, not an operating outflow, because they are purchasing a long-term asset. This misclassification contributes to an overstatement of investing activities by $700,000, because if you think about it, investing activities is currently higher by $700,000 than it should be, because they should have taken $700,000 out for that purchase. So it's overstated by $700,000. The $250,000 sale of the sculpture is correctly classified as an investing inflow, again, because they sold a long-term asset. Same thing with this, $500,000 purchase of the artifact. That's an investing outflow because they purchased an artifact. The $200,000 insurance proceeds should be classified as an investing inflow, not as an operating inflow, since it relates to the loss of a long-term asset. So this misclassification leads to the investing activities being understated because it should be $200,000 higher. They should have received $200,000 more in investing activities. The $400,000 sale of the investment portfolio is correctly classified as an investing inflow, and then the $60,000 payment for restoration work should be classified as an investing outflow, not an operating outflow. This misclassification contributes to an overstatement of investing activities by $60,000 because, again, it should have been $60,000 lower, but they didn't have that in investing activities, so they didn't take $60,000 out for that purchase. And then finally, a $100,000 restricted donation is correctly classified as a financing inflow. Now, there's a lot of information there, but basically the $700,000 purchase of the painting, the $200,000 insurance proceeds, and the $60,000 payment for restoration work were all incorrect. And because of that, it was overstated by $760,000 and then understated by $200,000. So you net that, and it's a net overstatement of $560,000 because it's $560,000 higher than it should be. There should be $560,000 less of investing activities because there should have been $560,000 net outflow of investing activities that weren't recorded correctly. So this was a big question to kind of help you remember that works of art, sculptures, art collections, things like that, those are part of investing activities because they are long-term assets. If you really think about what they're going to be used for when it's a nonprofit organization, people are paying to go look at those things. It's a part of the organization's purpose, and they're buying those as long-term assets to make the company or make the organization money, or at least to encourage donations. So again, they're long-term assets. That's why they're part of investing activities. Let's go to the next question. All right, here we are at question 3. A non-governmental not-for-profit organization recorded the following transactions during the year. But wait, before we jump any further, let's read this last part here. Which of the following statements correctly identifies and corrects the errors in the statement of cash flow? So obviously we're looking at these errors. Not too much to read here, so let's look at it. Received a $500,000 donation with a donor restriction to be used for the purchase of a new building classified as an investing inflow. Purchased a building for $450,000 using the restricted funds classified as a financing outflow. Now, we've already read about this just in this video, let alone in the previous video. So I think you could do this one based off what we learned, especially in question 1. So recall what we talked about, pause the video, think through this, think about the correct answer, or do the calculation if you need to, come back when you're ready. All right, and the answer is A. The $500,000 donation should be classified as a financing inflow, and the $450,000 purchase of the building should be classified as an investing outflow. So it looks like the company got flipped here. They got mixed up. So let's read through this to remember the rule. This donation, the $500,000 donation, is restricted by the donor for the purchase of a long-term asset, which is the building. That should be classified as a financing inflow because it impacts the organization's net assets. Donor-restricted contributions intended for long-term purposes are always classified as financing activities. At least as far as the CPA exam is concerned, that's a rule that you can count on. Maybe there's other situations that I don't know about where these donor-restricted contributions intended for long-term purposes wouldn't be in financing activities. But as far as the CPA exam is concerned, you can count this as a rule. Contributions that have donor restrictions that are specifically for long-term purposes, like purchasing a long-term asset like a building or a long-term investment for an endowment fund, things like that, that's going to be classified as a financing activity. And then the $450,000 purchase of the building, when the organization uses the restricted funds to purchase the building, is not a financing activity. It still, even though those funds were restricted and counted as a financing activity inflow, the outflow is classified as an investing activity because it involves the acquisition of a long-term asset. So again, we talked about that in the previous video. Looks like this organization got mixed up with that, so we had to pick the correct answer to kind of help with, fixing that. Now let's go to the next question. All right, here we are at question 4. A non-governmental... Oh, wait, before we do anything else, let's go ahead and jump to this part. What is the correct amount of net cash provided by operating activities? So we want to know what operating activities are. Maybe we're going to get a bit more information up here. A non-governmental not-for-profit organization provided the following information for the fiscal year and used the indirect method. Okay, that's important. We're using the indirect method to calculate net cash provided by operating activities. So they had the change in net assets of $250K, depreciation expense of $40K, gain on the sale of equipment $15K, decrease in accounts receivable $25K, increase in accounts payable $20K, received a $100,000 donation restricted for the purchase of long-term investments, purchase a long-term investment for $100,000 using the restricted donation. So with all that information and using the indirect method, the organization incorrectly calculated $450,000. Now, we don't know what the correct amount is yet, but it's telling us that they calculated it incorrectly as $450K. So what is the correct amount? What should they have calculated? Go ahead, pause the video. Again, I think that based off of your knowledge maybe from previous videos or just about the cash flow statement, you could probably pause the video and give a good attempt at this. So go ahead and pause the video, do the calculation, and come back when you're ready. We'll look at it together. All right, here is the answer. The answer is A. It should have been $320,000. So just a reminder, they calculated $450,000 and we should have calculated $320,000. So let's read through this explanation. Let's break down all of this and find the errors. So to start with, we start with the change in net assets, which again for a not-profit entity is basically the net income. We add back the depreciation expense. This is a non-cash expense, so it didn't affect cash. We have to add it back. And again, we're using the indirect method here. So we subtract the gain on the sale of equipment. So that should have been subtracted. The organization incorrectly added this gain, and we will see this by the total at the bottom, like how we know that they incorrectly added the gain instead. Gains from the sale of long-term assets should be subtracted from the operating activities because, again, it's something that increased the net income on the statement of activities, or in this case, the change in net assets on the statement of activities, but it shouldn't have increased it as far as cash is concerned because they didn't get more money based off of that gain. So that's supposed to be taken away from the cash. We add the decrease in accounts receivable, and that is one, we talked about this in previous videos, where you increase it because if accounts receivable is going down, that means you received the cash, or at least hopefully that you received the cash. Hopefully it wasn't something that was written off. You received the cash, so that means you increase your cash collected. You add the increase in accounts payable, similar idea. Because your accounts payable went up, that means you didn't have to pay expenses yet, so that's money you saved. So you add that cash in. And then it looks like they had another error here. And again, we're going to do their calculation to see how they got $450,000 here. The organization incorrectly included the $100,000 restricted donation for the purchase of long-term investments in operating activities. This amount should be excluded from operating activities as it is a financing inflow. So they got $450,000. Let's see how they got that. So they took this $250,000. They added the depreciation expense. They added the gain on the sale of equipment. So they would have been at $305,000 here. They added the decrease in accounts receivable. So they did that correctly, $330,000. They added the increase in accounts payable, $350,000. And then they incorrectly added this $100,000 donation restricted for the purchase of long-term investments, which that should have been a financing activity, but they added it. So $350,000 plus $100,000, that's how they got to $450,000. But we just looked at all of this, and it should be 250 plus 40, oh, it's down here, less 15 plus 25 plus 20, that gives you $320,000 in the end. That's the correct calculation. So this is something that you'll have to kind of look for, especially I bet you would see something like this more in a sim where you have to kind of look through what they did, look through the different transactions and kind of pick out what they did wrong. So make sure you pay attention to how to calculate it correctly. And by calculating it correctly, you can more easily see the errors that somebody might have committed. With that, let's go to the next question. All right, here we are at question 5. Now, before we dive into anything else, let's read this last part. What is the correct amount of net cash provided by operating activities? So similar question, but maybe it's going to be a little bit different. A non-governmental not-for-profit organization provide the following cash receipts and payments. The organization uses the direct method. Okay, so last question was indirect. This one's going to be the direct method. And then they have all of this information. So let's read through these different activities that they had. Cash received from donors for unrestricted purposes, $400K. Cash received from program service fees, $200K. Cash paid to employees for salaries, $150K. Cash paid to suppliers for program expenses, $100K. Cash paid for rent and utilities, $50K. Cash received from a restricted donation for the purchase of equipment, $250K. Cash received from the sale of an old van used in the organization's operations, $20K. Cash paid for the purchase of new equipment, $300K. So a lot of information there. They incorrectly calculated it as $570,000. So very similar to the previous question where it's telling us what they calculated, but it's not necessarily saying how they calculated it. And we have to go do the correct calculation. And by doing the correct calculation, we'll find out why they ended up with $570,000. And we'll also know the correct answer. So if you haven't ever used the direct method, that's okay. We're going to go straight into the answer for you. If you have seen this before, especially again, if you've watched the previous video, you might have a good idea of how to do this. So pause the video, do the calculation, and when you're ready, come back. We'll look at it together. All right, here we are at the answer. The answer is A, $300,000. Now that we know the answer, $300,000, they said $570,000, so that's good to remember. Let's read through the explanation here. We have to identify and correct the errors. Now, we're just going to dive straight into the things that they easily could have misclassified. The cash received from a restricted donation for the purchase of equipment, that's $250,000 that should not be included in operating activities. That should be a financing inflow, so we don't want to include that. Cash received from the sale of an old van used in operations. Even though it was used in operations, it's an old van, it's a long-term asset. This should be classified as an investing inflow because they sold it, not an operating inflow, so we don't want to include that. Cash paid for the purchase of new equipment. This is $300,000. That should be classified as an investing outflow, not an operating outflow, because again, it's for the acquisition of a long-term asset. So these are the things that it looks like could have been the errors. It's not talking about anything else that could have been the error, so we're assuming that the rest of these were done correctly, but these last 3 could have been done incorrectly. So let's look at the calculations here to see how they got the wrong answer. So for their calculation, they incorrectly included the $250,000 restricted donation and the $20,000 from the sale of the old van in their operating activities. So we can see their incorrect calculation here. They did include the $400,000 from donors, the $200,000 program service fees. They did take away the salaries, the payments to the suppliers, the rent and utilities. Those were all done correctly. But then they included the $250,000 restricted donation that was for a long-term asset, and they included the $20,000 from the sale of the van, which is from selling a long-term asset. So they shouldn't have included those, but they did. So they ended up with $570,000. Now, when you take those away, you end up with the correct calculation. All these same things. The direct method is pretty straightforward. You just take the cash receipts and the cash payments that have to do with operating activities, and you get to $300,000. So that is the net cash provided, and when it says provided, that means it was an increase in operating activities. So $300,000 increase in the operating activities. Now, again, that was maybe a little bit confusing because it was kind of a question that was meant to have you go through it yourself, think about the things that could have gone wrong, look at the calculation that they did, and then look at the calculation that should have been done to see where they went wrong. Now, I know we went over a lot in just 5 questions, and this was a little bit of a different topic because the previous one was about preparing, this one was about correcting. So before we go any further, let's do one more part of the Superfast CPA process called Pillar Topics. Now, the idea behind Pillar Topics is as you're going through the questions to learn the material, because again, that is the main idea behind Superfast CPA, using the questions to learn the material, you will notice the things that keep popping up. You'll notice the topics that they're obviously trying to teach you in your review course. You've seen 3 or 4 questions teaching you about how to correctly classify contributions with donor restrictions in the statement of cash flows for a nonprofit entity, or things like that. These are the things that keep popping up, so you know they're pillar topics or key points. You write them down in your own words to summarize, so you know them for later. So with that, let's look at the pillar topics for this video. All right, here we are at the pillar topics for this video, and for you eagle-eyed viewers, these are the same pillar topics from the previous video, because in reality, when it comes to preparing and correcting, you need to know the same things. You need to know how to prepare something to be able to fix it. So these are the same pillar topics as in the previous video to make sure that it's hit again. So let's read through this just to remind you. Classifications for restricted donations. Cash inflows from donor restricted contributions for long-term purposes like purchasing property or investments are classified as financing activities in the statement of cash flows, so don't mess that up, while the actual purchase of long-term assets is classified as an investing activity. I think this is something that could be really confusing if you don't remember this rule. Direct method for not-for-profit organizations. This is the direct method reports actual cash transactions related to operating activities, such as cash received from donors or program fees and cash paid for salaries or supplies, without adjusting for non-cash items or working capital changes. Now, the direct method is something that you're not going to be tested on for the for-profit organizations. You're only going to be tested on the indirect method for for-profit organizations. But when it comes to nonprofit organizations, you may still be tested somewhat on the direct method. So you should know at least roughly how to do it, but it's a lot more straightforward. It's not as complicated, so that's why they don't test it as much. As for the indirect method, it's very similar to a for-profit organization. It starts with the change in net assets, which is basically the net income, and adjusts for non-cash items like depreciation, gains, and losses, as well as changes in working capital to calculate net cash provided by or used in operating activities. So very similar, basically the same as a for-profit organization. And then finally, this is something that needs to be remembered. Transactions involving the purchase or sale of works of art are classified as investing activities in the statement of cash flows. This includes insurance reimbursements for lost or stolen works of art or collections. So anything that has to do with a work of art or a collection or a sculpture or anything like that for a nonprofit organization that has that as a purpose, like they're a museum or something like that, then those are investing activities because those are long-term assets for those companies. And with that, those are the pillar topics for this video. Again, they're the same pillar topics as the previous video because to be able to correct something, you need to know how to prepare it. Same idea between both. And this is a big part of the Superfast CPA strategy. Again, making these pillar topics based off of the questions you studied. And the main idea behind Superfast CPA is studying the questions first. 80 or 90% of your time should be spent in the questions because that is what you're going to be doing on test day. So make sure you go check out our free 1-hour webinar training on superfastcpa.com. Again, it's only 1 hour, it is free, and we will teach you the key ingredients to passing the CPA exam for free so that you don't have to waste months or even years of your time doing ineffective strategies. If you like going through these questions with me, just remember that Superfast CPA members will have access to the full 10-question video because we only went over 5 questions here, where we go over more questions so that you can get more practice. So again, make sure you become a Superfast CPA member if you liked going through these questions with me. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.